Welcome back to Your Money Matters. I am Angela Jarrell, publisher of the Bauman Letter and your host. And joining me are Ted Bauman, our editor, and Clint Lee, our research analyst. Now, Clint, I have to congratulate you. Once again, Mr. Bullseye strikes. Clint just closed out his 15th winning trade in a row in Flashpoint Fortunes. You haven't closed out a single loser, as a matter of fact, since you started in November. So congratulations to you and all of your subscribers, of course. If you want more information about Flashpoint Fortunes and how he's doing it, there's a link above and there's also one below, and you'll want to check this out for sure. So, Mr. Bullseye and Ted, I'm going to put you a little bit on the hot seat today because I want to get some specific ideas from you. We really have sort of two stories going on in the market right now. We have tech stocks, which had quite a year last year, having quite a year this year as well for different reasons. And then we have the recovery stocks. So I really just want to pick your brains and I want to get some ideas, some specific ideas of stocks that may be a good idea right about now. So Ted, let me start with you and let's start with tech. Are there any good ideas in tech? Let me ask you that question first.
Well, gee, that's, yeah, there are lots of good ideas in tech. I think, right now my bias is really towards kind of steady accumulative growth in positions, because I don't think we've seen the last of the volatility surrounding some of the more flashy, high growth, high buzz names. So strangely enough, I'm actually going to plump for Microsoft as a company that people should be adding to their portfolios right now. And I have a couple of reasons for that. The first one is I want to show you a chart that shows Microsoft versus the main sort of technology ETF XLK going back the last 10 years. Microsoft beats it, pretty much hands down. I mean, it has outperformed, not in every time period, but overall, Microsoft has significantly outperformed the tech sector as a whole. A second chart I want to show you, though, is the inverse relationship. In other words, here's basically Microsoft stock divided by that same ETF, XLK. And what it shows you is that as the line rises, it means Microsoft's value is rising faster than XLK. Now, look at the upper right-hand corner. You see that reversed last year. And that reverse last year was because there were so many technology stocks that were just like runaway trains, right? That they were growing faster than Microsoft. But then look what happens at the very end of the chart. Microsoft starts to rebound. Now, this last chart I want to show you shows that in more detail. This is actually Microsoft versus ARKK, which is everybody's favorite ARK ETF, and that's the one that had such a great year last year. This is over a 3-year time frame. Microsoft actually beat ARK hands down right up until the beginning of last year, and then ARK took off. You can see that by the downward slope of the line. That means Microsoft was growing by less. But now look what's happening. Microsoft is starting to rebuild. So here's my bull thesis for Microsoft. I believe that Microsoft is positioned to benefit from this big infrastructure bill. I'm pretty sure the Democrats are going to pass it. They need to pass it if they're going to stay in office in 2 years. So if they do, one of the big things is that this is going to involve the digitization of things like transport, energy, a lot of things, smart cities, all these things that we've been talking about for years. It's likely to happen. And Microsoft is really the main operating system for computers, even servers, whatnot. They still have a huge market share there, and most importantly, they have the world's leading cloud service provider in the form of, or one of the world's leaders in terms of Microsoft Azure, their cloud service. And I predict that, strangely enough, the infrastructure is actually going to help Microsoft, a tech stock, do better than a lot of people suspect it will. So that's my tech pick. May seem odd; it's an old dinosaur, really, in the tech sector, but I think it has legs.
All right. Well, you're not off the hook yet because I do want to get your pick for the recovery.
The recovery. Okay, here's who I like for the recovery. I like a company called Cleveland Cliffs. It's an iron and steel. It's interestingly enough, it's a company that actually has vertical integration in the steel sector. So it mines ore, but it also produces steel, which means that it can it has a lot less risk on the supply side than a lot of companies that just produce steel and don't have the mining background. But the other thing is that it also produces steel for other companies and provides inputs to other companies. So it has multiple ways to make money. And I think obviously with an infrastructure thing, any steel company is going to do well. But here's why I like CLF in particular. Here's a chart that shows their growth grade. I pulled this from Seeking Alpha. And look at their year-on-year revenue growth. Now, I know that that's an exceptional year, that basically 2020, if you're doing year-on-year between last year and this year, it's going to be better. But look at it compared to the sector median, for iron and steel companies, it just blows them away. Their forward revenue growth for this year predicted also just completely blows away. I mean, it's like, it's 2,500 times more than the sector median. And then also their earnings, their basically cash flow earnings are much better than their competitors. The last chart is a value chart that shows their pricing relative to the sector median. Look at that. Their non-GAAP PE ratio is under 6. The sector median is 16. Their GAAP PE is a little higher, but also just a fraction. It's 62% less than a median. So you have a company that it has faster growing revenues. They have multiple revenue streams in a sector that's going to be hot under infrastructure, and it's dramatically underpriced relative to its peers. What more is there to like?
All right, Clint, now how and where are you going to find good opportunities in tech?
Yeah, so starting with the tech trade, I mean, we had the S&P 500 crossing 4,000 just the other day. So that means, trailing valuations are becoming more expensive as well, which I know can be an issue for a lot of investors looking at the tech space here domestically. So what I did was look abroad at, were there other countries or regions where you could get exposure to some of the high growth areas of the market, but at a better price point. And South Korea is a country that stood out in my scan. If you look at the iShares South Korea ETF EWY, it has about 40% exposure to the tech sector. About its top 2 holdings are involved in with semiconductors. There's companies in the battery space and the electric vehicle space, other forms of renewables. So all these high growth areas of the market you can get exposure to with these South Korean companies. But then here's the thing. Here's a chart that shows South Korea's CAPE ratio. So that's a cyclically adjusted PE ratio. All it does is it just takes price and divides it by an average of earnings for the last 10 years or so. And that's the blue line. The orange line is where the S&P is at on here. And so you have the S&P, especially with this most recent uptick in prices, is now at a ratio of 35 versus South Korea is trading at a ratio of just below 18. So about a 50% discount in valuations in South Korean stocks relative to where the S&P is at. And that makes it an attractive pickup for those growth areas of the market. Now, the other thing I like about the South Korean ETF is where we're at on price. So I'll just show a chart really quick of EWY here once again. And you can see, I mean, since about January, we've been in this relatively tight consolidation range. We dipped below the 50-day moving average, which is the black line on here. But then what's caught my eye just recently is we hit this 86 level twice on price. And that's what I'm showing with the green line on here on the price chart. We hit 86 once, rallied a little bit, then came back down to it. But at the same time, you had the stochastic in the middle pane of this chart. It made a higher low, so it didn't dip by as much. And you saw the same thing with the MACD indicator down below here as well. It didn't go as low during that second trip to 86. So those are positive momentum divergences. At the same time, you saw price. It's hard to see on this chart, but price retook its 50-day moving average just the other day. So I think this is a great spot, very opportunistic to add exposure to EWY to get that more bargain tech exposure out there.
All right, so we've got EWY for tech. What about the recovery?
I think for the recovery trade, I think it comes down to looking at the energy sector, especially the domestic energy sector. I mean, here's a chart of oil production. Going back a couple of years, you can see the decline we had throughout the pandemic. We've stabilized and just have kind of moved sideways on production, but you're seeing an uptick here just recently, and one that I think we're going to follow through higher. And a lot of that just comes down to travel demand. You're seeing more people, traveling on airlines via the TSA throughput statistics they put out there. I know, Ted, I think you were contributing to a couple of those numbers here in the last week or so. The other thing is that gasoline demand is recovering. So here's a chart of gasoline demand. This actually compares daily demand for gas against the average of what it was in February of 2020. So what that's doing is looking at where daily demand has been and the month before all the economic lockdown began. And so you can see for the longest time, that percent change, we had a sharp dip, but we've stayed below zero. But just until recently, now, just in the last month or so, we're starting to actually see year over year, we're starting to see gains in gasoline demand relative to what it was just before the pandemic. So we're actually running really close to where we normally would be. So you're seeing that demand return, but then, similar to what EWI is presenting us with an opportunistic buying point on the chart, I see the same thing with the oil exploration production ETF. It's ticker XOP. And so here's a chart of XOP. And we had this monster rally since November, but we've recently, just in the last month or so, retraced a lot of those gains. But there's a couple key levels to pay attention to on here. So with the arrow, I'm highlighting that price came back down to the 50-day moving average. That's frequently a good level of support. But at the same time, you had the stochastic getting oversold. You also had the MACD indicator sort of resetting at the zero line. That tells me, these two indicators, along with finding that support, we're starting to see this ETF turn back up. We had a big jump in price just the other day. And the reason I took this chart back a couple years is just to highlight then sort of the importance of this $90 and $100 level that's coming back into play. I mean, if we see the momentum pick up and we break out over those levels, there's a lot of meaningful upside ahead for this ETF.
All right. Well, for those of you watching, I hope you paid close attention. One last chance, grab your pens. Ted, your two picks?
Microsoft in technology, which is also a kind of a sneaky backdoor play on the recovery, and CLF, which is Cleveland Cliffs. I like them for a lot of reasons, recovery or no recovery.
And Clint, to recap yours?
Yep. Cheap tech with South Korea, ticker EWY, and on the recovery trade, just playing the recovery and travel demand as well, and what that's going to mean for oil prices and companies producing oil with ticker XOP.
And a reminder to those of you watching, we'd love to hear from you in the comments. Let us know what you think about these picks. And of course, while you're at it, find out more about Flashpoint Fortunes and its 100% win rate. Thank you so much for watching, and we will see you next week.